Okay, guys, so listen, I'm very lucky today to have a CPA, a very highly regarded CPA, Eric Zielinski from Eric Zielinski and Company, LLC. He's located in Fairfield at One Post Road. And Eric was kind enough to join me here on this Zoom meeting today. And he's very, very busy right now. He's right in the heart of tax season. So, Eric, thank you very much for coming on for a few moments to
You're welcome, Jay. Glad to be aboard.
appreciate it very much. Thank you. So, I've been in the real estate business for a lot of years, 38 years now. And over those, and it's constantly when I'm going on a presentation or I'm talking to buyers or sellers, they're always asking me questions about, tax ramifications and financial questions that I don't feel comfortable at answering them because I'm not a CPA. We all know that, home ownership is the American dream. And and we all know that obviously over time, when you own a home, you're paying down your mortgage and your the value of the house increases. So it's a tremendous investment. But people, besides the equity buildup that your house, creates for you, what are some of the other benefits of home ownership, as far as any tax implications and things of that nature that you can save money on? You used to be able to write off your taxes and let's say your insurance and principal and interest or what. Talk to me about that if you wouldn't mind.
All right. Well, one of the nicest things about owning a home is that, yes, you can get additional tax deductions for doing that based on the mortgage interest and real estate taxes. That used to be a lot more effective until the Trump tax law changes a few years back, where the taxes were limited. And also where the automatic deduction that they give you was doubled, which meant that you had to pay a lot more in interest and other types of deductions in order to be able to utilize that. So not everybody can use it as much as they used to, but they still can, especially with larger mortgages. Um, that those penalties based on the tax law didn't hit single owners as much. So actually, the tax benefits now for single owners of properties is better than it was before. So that's thing one, because that's an ongoing deduction that you can have every year. The other part, which is really cool, is when you sell the house, then up to $500,000 of your gains from the sale of that are tax exempt. You don't have to pay taxes on it.
Is that if you own it jointly, or is that if you file jointly?
500K is joint, married filing joint, and a single individual is 250K.
Right.
So, that used to be a lot, but in what we've seen the past couple of years with the jumps in prices, it's been pretty well utilized.
Now, again, the capital gain means your capital gain. So if people have lived in a house for say 20 years, and over that 20 years they put furnaces in and roofs on and new windows and central air conditioning and on and on. Do you think it was wise of them to save on or hang on to all those receipts because that'll reduce their capital gain?
Yes. Well, a capital gain is based on the amount that you originally invested in the house, plus improvements, roofing, driveways, landscaping, things like that. And so, yes, you do want to keep track of all those because the cost basis will increase as a result of all those costs. And at the end of the day, when you sell a property, it's going to be that accumulated cost compared to what you sold it for that's going to reflect the gain. So yes, you do want to keep track of those.
Yeah, that's important.
Mm-hmm.
A lot of people have also been flipping houses too, Eric. Over the past,
Yeah.
past years, you probably run into those a million times. And when you're flipping a house, I'm sure it's a different situation, correct? A lot of my clients flip houses.
Yes. Yes. But it could be in two different ways. Okay. If you buy a house and flip it and you just do it once in a while, then that's capital gains, any kind of profit that you realize. And same concept though, the original cost plus whatever improvements you make into it before you sell is your cost. But with a flip, that's not subject to that 250K or 500K freebie. You've got to pay taxes on the entire gain. And it could be one of two different ways. If you do this all within 1 year, then that's short-term capital gains, which is at a higher tax rate. If you do it over a year, that becomes long-term capital gains and the tax rates are much lower. So if you're gonna flip a house, wait until at least a year goes by before you sell it. Now, here's the problem that people run into, Jay. If they start doing it more frequently than that, then they're classified by the IRS as being in the business of flipping houses. And that means no capital gains. That means it's all ordinary income, fully taxable, including self-employment tax.
You don't want to go that route if you can avoid it.
Exactly, exactly. But sometimes people do that. They start getting good at it, and once they hit the thresholds, all of a sudden it's like, wow, and now it's completely different. So, but
Wow.
yes, flippers can make money doing that, and long-term capital gains too, if they do it right.
Something else that I run into quite a bit, Eric, is that, people are in the process of inheriting their parents' home. Their parents are, are older now, or either they A, pass away, or B, they're, for example, I just had a client who the mom is very old. She has dementia and she is beyond the point where she can quit claim the house, or it's her house, it's in her name. But my question to you is, I don't think it's a good idea, even if they have full power of attorney over their mom, to actually quit claim the house, because isn't that a gift at that point?
A straight
I
gift is a quick claim deed. That's correct. And that may or may not be the right way to go. You have to look at the entire picture. But generally speaking, if you're going to give away your house at that point without putting it into a special trust or any kind of legal structure, then yeah, it is. It is. It gets it out of your estate, but it can create other complications, especially if this woman is trying to qualify for Medicaid. That's always a consideration in gifting at that age. But talk to an estate attorney when you're thinking about doing that, because there's all sorts of pitfalls and different directions that you can go in doing it.
Yeah, because again, that's, even when you're inheriting a house from your mom, they passed away, your parents are gone, and now you've got to go and empty out the house and sell it.
Right, but now, okay, that's a different situation. That's actually a very, very good situation in terms of the taxation of it, not because of the parent passing. But when a person passes away, then the cost basis, remember we were talking about that before, which is usually what you purchase it for.
Yes.
Well, that cost basis is the value on the date that the person passed away. So if your mom bought that house 40 years ago for $25,000 and it's worth $1 million now, your cost is now $1 million.
Of course.
After that step up.
Is
And
there anything they can do with that money to offset the taxes? Once they inherit the money, once they inherit it, is there anything that they can do with the money so you don't have to pay that kind of tax? What do they call it? They do the 1031 flips, they do all, 1031 transfers, all kinds of things. I'm just asking.
well, let me throw an example at you, Jay. Okay, in that same thing where they bought the house for 25,000 and it's now worth $1 million. Once it passes through the estate to the beneficiary, and let's just say you're the only beneficiary, you now have a house on your hands that you bought for $1 million.
Right.
If you sell it for $1 million, what's your gain? Zero.
Correct.
And usually what happens is if you sell it right after, if you throw in closing costs and everything else, that reduces the sale price. Even if you sell it for the exact same amount that it was valued, you actually have a loss.
Interesting.
Which is, so the house can either be sold through the estate, in which case the estate recognizes any kind of a gain or a loss. Or if it actually passes through to the beneficiaries, they can do what they want with it. They could live in it, make it their new residence. They could rent it, or they could sell it. One of the three.
Some of the other questions that were asked for me to ask you.
Yeah.
Somebody said, I spent a lot of money, Jay, getting my house ready to sell. What can I claim as a deduction? Improvements.
They have to be improvements. If it's minor maintenance and things like that, no, because that's a normal cost of owning a home. But let's say that you you redid the kitchen because it was old, needed to be redone, that would be a capital improvement. And that would be actually an increase in the cost basis. So yes, you would be able to reduce your gains with that.
So if you bought it for 200, it cost 100,000 for the kitchen. Now you're to
Now
$300,000.
you're at 300,000, right?
Gotcha. Someone else asked me. They said, Jay, I have to give a big chunk of my sale to the real estate, real estate commission, and also
Mhm.
my attorney fees. Are those fees deductible?
They are. But rather than adding to the cost, because of tax law, they reduce the sale price. So let's say $1 million sale, 5% is 50 grand is all your commissions and everything else. Your sale price is now 950.
Okay, so it comes down
So,
to your cost base.
right. The net effect is the same, but it's just the way that it's actually treated by the IRS.
Yeah, so they said, can I write off my lawyer or my accountant? Question mark.
Yeah, it will reduce your gains. Yes.
Will reduce your okay. Okay, it said since I won't own since I won't own the house at tax time, can I deduct any home mortgage interest?
Not sure I'm understanding that. Who are we talking
Since
about?
I
Not
won't
owning.
own the house at tax time, can I deduct any home mortgage interest? Well, if you don't own the home, how can you deduct?
Yeah, I'm not following that question.
Okay, we'll go to the next one.
So,
Real estate taxes for the
wait a minute. I think I know what they might be talking about.
okay.
You know how sometimes, maybe the parents can't pay for the mortgage anymore. Your mom can't pay for the mortgage
Sure.
and the kids pay for it. That may be like, okay, if the kid pays the mother's mortgage, can they take a write-off for the interest? That may be what they were asking.
It could be. Sounds like it could be. Yeah. Is that
And,
possible?
and the answer is no. And the reason is very clear. The mother is the one that's named on the mortgage as being the person that owes the money. So if somebody else pays for it, they can't take the deduction. It's only if the mother pays for that.
Let's see.
So now one thing that you can do, if you really want that to work, is to have the money gifted to the mother, and then she makes the mortgage payment. Then she can take it. But the person that really was the source of the money can't.
Gotcha.
So,
Years ago, I was told that if you took the property out of your name and put it in your children's name, 3 years prior to them passing, then it's not a gift.
now you're starting to talk estate tax planning.
Right.
And 3 is a possible way that you could do that, especially if you form what's called a qualified personal residence trust. But now you're starting to get into estate planning, which is different from income taxes.
Yeah. And again, sometimes, parents do worry about things like that. Sometimes they do want to get the properties out of their name, put them into their kids' names for these reasons.
Right.
And
No, you can do that. But this is something that you would want to make sure you do properly.
life
And
use.
so you need to talk to an estate attorney or a Medicaid planning attorney, someone along those lines, along those professional lines.
Gotcha. Perfect. My real estate taxes for the entire year were prepaid. Can I claim them? No, because it's
Prepaid is kind of vague. Bottom line is if you paid the taxes during the tax year, yes, you can. So if, say, like on January 15th, you prepaid for the entire year, then yes, you'd be able to claim that subject to tax limitations, which is like $10,000 now. But if that's what they're talking about as far as being prepaid, but if you prepay in 2022, paying taxes in 23,
yeah,
that's a deduction for 2022, not 23.
of course. Yeah.
So it depends on how they're asking that question.
Someone else wrote, can I avoid paying tax on the gain by flipping the proceeds into a new house?
Oh, years ago, you probably remember this one, right? Back in the 80s and 90s.
Of course.
Back then, as long as you purchased a house that was more expensive than the one that you sold, then you could roll those gains forward. Yes, but that's been gone for a while.
Okay, so that's a no.
That's a no. But every once in a while, you still run into people that bought their houses then, and you have to take that into account when they sell it now.
Are there any tax implications for renting their current residence versus selling it?
It depends on how long you do that for, okay? One of the qualifications for declaring something as a residence is that you live in there for 2 years at least before you can start taking that deduction or that exclusion of gain.
Sure.
And the other rule is you have to have lived there for 2 out of the last 5 years. So if you think about that, you can rent it for 3 years before you sell it and still be able to have deferred capital gains or excluded capital gains treatment. But you have to be very mindful of those dates because you fall outside of that, outside of either one of those two rules, and you can't.
They're constantly changing, constantly changing. Someone asked me again, and they said, Jay, do I have to pay income tax on the sale of a home that my mom transferred to me just before her passing away? Now, that might be a gift.
That's definitely a gift. And then
Yeah.
whatever the cost basis was that of the parents before they gave it to them is going to be their reference level. And that'd be tax suicide in order to do that. If you're going to do that, you have the parents sell it before they gift it. But if you're going to gift it before they pass away, and then you're going to sell it before they pass away, that's the absolute worst thing that you could do.
Yeah, I get calls from attorneys constantly asking me to do a fair market value letter. It has to be at the time of the date of death, the property's value, the date of the person's passing. Someone else asked me another good question. I hear they said, which one is it? Withdrawing funds from your IRA to purchase a home or your retirement account to purchase a property, obviously you need to you take that out as a loan, correct?
Well, you can take a loan from your IRA, basically. So if you take something out and it's your first time buying a home, then there is an amount that is excluded from penalties. Because usually if you take out retirement money before you're 59 and a half, you got to pay penalties, 10%. So there's an exclusion of taking money out of an IRA to buy a home for the first time. First time home buyers exclusion.
There is a first time, yeah, okay.
401ks are more complicated. Depending on how sophisticated the plan is, and some of them are very simple and some of them can get very complex. You may be able to borrow up to $50,000 from your 401k and use that for the down payment of the house. But you got to pay it back. It's a loan.
How long do you have to pay it back?
I believe it's 5 years to pay it
Okay.
back. Yeah.
Okay.
And they at one point it was 10, but now it's 5. And it's kind of like you're making a loan to yourself from your retirement.
Yeah, exactly.
But you don't want to take a distribution. Distribution is all taxable. You don't want to do that if you can avoid it.
A lot of people say to me all the times too, Jay, what are the tax implications for renting we talked about that, but people sometimes just want to rent their homes rather than sell their homes because they don't want to pay taxes.
Mm-hmm.
Um,
Well, if you rent your home, there is one other deduction that you have that you normally wouldn't, and that's depreciation.
okay.
Right? And those are set by IRS guidelines in terms of how much, but basically, whatever the cost basis is in the house or the building is written off or depreciated over 27.5 years. That's so let's just say you had $1 million house, or no, a $270,000 house. Let's make it easy. Then you'd be able to write off $10,000 a year.
Gotcha.
And that's not something you have to write a check for, but a lot of times that will help to produce a loss on the rental of that property.
Right. So is there any, listen, I promised you I'd have you off by 10:30. It's 10:30 now. And again, I want to thank you so much for your time, Eric. I really do. I know how busy you are right now, especially this time of year. But is there anything that you might want to say, or if in regards to what somebody can be doing right now with the upcoming tax season to save some money in taxes when they're going to purchase or to sell a home, or anything that you might want to, the advice you'd give to your kids?
Are you talking about specifically in real estate?
Just overall,
Real
just
estate
a general
associated?
CPA question. Yeah, if you're buying or selling a house, any advice you give to your children or anything of that nature. Maybe not. I'm just throwing it out there.
I would say the best thing to do is if you're a parent and you're considering gifting something to your children, real estate or otherwise, is to make sure that your will is up to date, and during that process, work with an estate attorney in terms of whether it makes sense to or not. Because what works for you might not work for me.
Right.
And a lot of times people just say, well, my buddy Joe did this with his parents' house. Why don't we do this with ours?
Right.
And it can result in very, very different tax circumstances. So best thing to do is don't jump, go into something carefully when you're planning on moving property like that. The other is, well, it used to be that you could bunch together your tax transactions at the end of the year. So you maybe pay 5 quarters worth of taxes in December, so you can take a deduction for it, but that really doesn't exist anymore.
Right.
Unless it's a rental property. Rental property, it doesn't matter. There are no remember that $10,000 cap for taxes?
Yeah.
That doesn't exist with a rental property, which is nice. So you could plan with that.
Yeah.
That's about it for now.
This was wonderful, man. I mean, you answered a lot of questions that folks were asking me.
Well, you sure had a few of them, Joe.
You know, a few days ago I came up and boy, they started firing questions out at me. I said, "Oh, this is good." And you handled it.
Glad to help, Jay.
Thank you. Listen, thank you so much, Eric. I sincerely appreciate your time. And again, I know how busy you are right now. You got a busy firm out there, so
Yeah,
I know. Thanks for your help.
41 days to go. All right.
And who's counting though, you know?
Take care, Jay. Be well.
All right. Thanks again.
You're welcome.
See you soon. Thanks, Eric.